So first of all, do you believe that gold and silver at current levels are finding some support that's recognized, that's demonstrating some support at these levels, or that we're still at a frothy top on both of them?
Well, I don't think they've ever really been a frothy top. I mean, there was a very brief moment when you could say that silver was a frothy top. Got up to what, sort of 37-ish, something like that. I mean, but really the reaction has been very, very minor from that frothy top. And the same with gold. I mean, gold sort of spiked up early one morning to 3,500, but it's just been moving sideways. And in these, as I was saying earlier, in these very quiet trading conditions, you would expect it to drift lower. I mean, I talk, if you like, as an ex-stockbroker, and I knew that in the case of any stock, and it's the same has got to be true of commodities, in the absence of buyers, prices go down. Now here we are with gold, close to all-time highs. You've got no interest in the market. I mean, really very little in retail interest, that is for sure, because everybody's just out there enjoying the weather. Or, and this is what I found as a stockbroker in the UK, I mean, it was so frustrating the summer months, because there was I on the floor of the stock exchange or in my office trying to contact clients to find that my competitors had taken them out to Ascot, Henley, all the sporting facilities. I couldn't get onto anyone and get them to deal because they were already being, wined and dined by my competitors. It's the same thing now. Nobody's interested. And you would think gold and silver would drift off, but no, they're not. I think part of the reason is the weakness in the dollar. I think you've got to look at the dollar from the foreigner's point of view, always. They own, in terms of dollars and underlying financial assets, including about, I suppose, 7.5 to 8, or no, it's about 7 trillion of bank deposits, figure like that. Total is just under 40 trillion, of which I think about 14.5 is in equities. I mean, this is a lot of stuff to be sitting on when the dollar's going down. And the dollar from President Trump's if you like, Liberation Day on April the 2nd, dollars lost well over 10%. So where have you made up the currency loss on your underlying investments? Well, the answer is you basically haven't. You might have done a little bit, I suppose, if you'd sort of continued to invest in NASDAQ type stocks, the Magnificent Seven, because they've performed reasonably well. But you're buying into hot air. I mean, come on. It's, the idea that these stocks are value, if you like, it's just nonsense. If I was a foreigner, I would be, I'd really be reducing my positions, particularly when you get President Trump turning around and saying, the dollar should be lower. Okay, well, if it's going to go lower, that's not going to do me any good. And also President Trump turning around and slagging off Jay Powell. I mean, you begin to think, well, who's running things here? Right? Slagging off Jay Powell is actually a very bad thing to do. I'm not saying that I think Jay Powell is necessarily the most wonderful human on the planet, but, if you want stability in a currency, the last thing you do is start slagging off the guy who's actually running the most important institution providing that stability. He's doing the job to the best of his ability, and I would say he's actually been doing quite a good job. If you like, the misconceptions that are around, Fed economists, but because he's got to reflect the consensus, I guess. But I think he has actually been doing quite a good job. And to have a president turning around and saying, I'm going to sack this man as soon as I can, and all the rest of it. If I'm a foreigner owning dollars, I don't think I want to own dollars anymore. And the point is, there's 40 trillion of these dollars held by foreigners like me. Why hold them? And particularly, I mean, if you're, let's say, a trading business as opposed to an investor, you hold dollars for international liquidity. I mean, you've got to go out and you've got to buy commodities and all the rest of it, and you get payments, and you're going to end up with some liquidity. You've got to have liquidity. But now that the global economy is turning down, and even though governments aren't admitting it, you probably see it in your own trade, seeing what's going on with shipping and all the rest of it, you got too many dollars. Sell them. It doesn't make any sense holding on to them. The problem is, what do you sell them for? Well, if you're a foreigner, and let's say you're, a German manufacturer like BMW or Mercedes or someone like that, you account in euros. So anything out of euros becomes, if you like, a risk, a profit risk. So what you do is you may not like euros, but basically you've got to sell your foreign currencies and go back into euros. And that basically, I think, is what the dollar is suffering from at the moment. I mean, particularly euros, yen also, but I think probably to a slightly lesser extent than euros. And when it comes to sterling, it hasn't really started in sterling yet. I really don't think it has. Well, that could be the next shoe to drop, I must say. Selling sterling for exactly the same reason, because sterling is overowned, and it's overowned because London is the international financial center in the European time zone. Banks and institutions and all the rest of it have sterling, and I can't see for the life of me why they should. So that, I think, currency problems are going to be continuing, and I think they are probably still mounting. And under those circumstances, I really can't see any meaningful selling of gold or silver. And I would have thought that, if anything, gold and silver represent really pretty good bolt holes for those getting out of these risky currencies.
You know, it's remarkable when you stand back and take a calm look at where we are right now in this monetary environment. Because most people, even those who consider themselves relatively well-informed, still haven't internalized the magnitude of the structural changes happening beneath the surface. And you can almost sympathize with them. After all, on the surface, it looks like we're in another typical cycle. The Federal Reserve raises interest rates, talks tough about inflation, markets wobble a bit, and then we all go back to buying the dip. Rinse and repeat. But this time, it's quite obviously not that simple. And I think it's why you see gold and silver behaving in such a curious fashion. Even with very low retail participation right now, I mean truly dismal retail interest, which you can confirm by simply looking at the lack of speculative flows into ETFs or the relative silence among retail brokers pushing gold and silver. The prices are simply refusing to break down. That tells you there is something deeper going on. Now first, let's talk about the structural position of the dollar, because this, to my mind, is absolutely at the heart of why gold continues to hold near all-time highs, even in what ought to be seasonally weak conditions. From President Trump's Liberation Day speech onwards, and you'll recall that was when he essentially laid down his economic marker for a weaker dollar to drive American exports. The dollar index has quietly shed more than 10% of its value. And you've got to put yourself in the shoes of a foreign investor here. Think about the German manufacturer, the Japanese pension fund, the Saudi sovereign wealth fund. These institutions collectively own nearly $40 trillion in dollar-denominated financial assets, from equities to bonds to plain bank deposits. So if the currency in which those assets are priced drops 10%, that's an immediate and very real wealth hit. And that pain becomes even more acute when you consider that the primary reason they've held dollars all these decades was for stability and liquidity. So naturally, you start seeing this quiet migration. It's not a stampede, at least not yet, but it's a steady trimming back of dollar exposure. And where does that money go? Well, sure, some of it goes back home into euros or yen, even if those aren't exactly pristine alternatives. But increasingly, the long-term parking spot is physical gold. Because gold is the only major financial asset that sits entirely outside the liabilities of any government. No counterparty risk, no central bank printing press to suddenly dilute your holdings. Just an inert lump of metal that's held its purchasing power for thousands of years. Now, people sometimes say, well, Alasdair, if all these global investors are moving into gold, why isn't the price soaring even more? Why aren't we seeing $5,000 or $10,000 an ounce right now? And my answer is, you've got to look at how these reallocations happen. Central banks and sovereign institutions don't ring a bell and dump all their treasuries on the market one day to buy gold the next. That would crash the very market they're trying to carefully exit from. Instead, they buy consistently over long periods and very often through opaque channels that don't immediately register in the visible global data. And by the way, if you want proof of just how stealthy this operation is, look no further than China. For years, their official gold reserves were stuck at the same number on paper. Yet China was the world's largest gold miner and also imported thousands of tons annually through Hong Kong. Where was all that gold going? It certainly wasn't being immediately declared as reserves. It was being quietly accumulated in various government-related accounts, including around the People's Liberation Army and the state commercial banks, which are de facto arms of state policy. In my estimation, by the time they began slightly more actively reporting additions to reserves around 2015, they were already sitting on upwards of 20,000 tons of gold. And even today, Goldman Sachs, a bit late to the party, but they finally caught on, recently put out a research note suggesting that China's true purchases are at least 10 times higher than their official monthly announcements. Well, that's precisely what we've been arguing for years. And this is all part of a long, methodical process by China to build an alternative monetary system. Think about it. They've been setting up yuan settlement agreements with dozens of countries. They've opened a Shanghai gold exchange vault in Hong Kong and have plans for one in Saudi Arabia. That's a strategic masterstroke, by the way, because the Saudis are the biggest oil supplier to China, and having a local vault means they can easily swap yuan for gold or gold for yuan as trade balances shift.
Well, there are parallels. I mean, the parallels basically are unsustainable debt. The difference is that your political class don't seem to realize it, whereas ours have woken up to it. We have a treasury here, a treasury department, who places great emphasis on balancing the budget. And it didn't take very long for them to persuade the current Chancellor, Rachel Reeves, that she must balance the budget. So what did she do? She raised taxes and raised them in such a way that satisfied her socialist and trade union audience. So, and at the same time, she also raised government spending, particularly on salaries, doctors' salaries, public sector servants' salaries, salaries for railway workers, and so on and so forth. So she increased taxes, perhaps she thought slightly faster than she was increasing the costs. And as it turns out, actually what's happened is that the costs are rising faster than she raised the taxes. She raised the taxes basically has also backfired because what she did was she chased away the big taxpayers. I mean, we have a very unbalanced situation here. The top 1% of taxpayers pay 30% of the income tax. If you upset the high earners and they leave, then you can have a big hole in the income tax returns. And that's precisely what she's done. People have been leaving the country. They go off to Dubai, they go off to Italy, they go, anyone who'll offer a better tax deal, thank you very much. Goodbye. And there's basically the problem with socialism, this form of socialism, is we just hope the last person to leave the country will remember to turn off the lights. That is, if there's any electricity, because that's the other thing they're doing. They're basically messing up the energy supply situation under the guise of this, climate change thing. The minister involved, Miliband, is very far left. And the one thing that we can, I think, pretty well demonstrate is that it's the very far left who are the keenest to clamp down on fossil fuels. I think they see, the oil industry as being evil, if you like, evil capitalists. And they really do want to clamp down on it. And they basically want to kill capitalism, let's face it. So you've got this sort of extraordinary situation of a government which started off pursuing its, sort of pet hates, like sort of wealth and all the rest of it. The bourgeoisie. I mean, it's just a step away from extreme communism, this lot. And it's all now going wrong. So what happened is that in the last few weeks, the government has sort of realized the error, has been pointed out to it in no uncertain terms, and then decided to try and cut the benefits bill. The problem they have in doing that is that Labour MPs are elected, basically, to promote welfare. Their USP. So unsurprisingly, there was a huge, great revolt, so much so that the government has had to back down completely on any welfare cuts. Now, that gives a political problem because of, the credibility of the government and the credibility of the Chancellor in particular, and there's talk about she's going to have to resign and so on and so forth. And indeed, today we saw gilt yields, the version of our government bonds, rising quite sharply, and at the same time, sterling falling.
And that really is where it starts to get very interesting or very disturbing, depending on your perspective. Because the world is waking up, albeit in slow motion, to the colossal concentration of risk tied to the dollar. We're talking about a global system in which roughly $40 trillion in financial assets, bank deposits, and international reserves are tied up in a currency that is actively being undermined by its own political stewards. Now, of course, this is a process that's taken decades. This didn't start with Trump or Biden or Obama. You could take it back to Nixon closing the gold window in '71, or even further to the slow corrosion of the dollar's link to real value that began under Roosevelt in the '30s. But what's different now, what truly makes this an inflection point, is that for the first time in living memory, you have foreign holders actively questioning why they continue to sit on massive piles of these paper claims. And look, as I've said before, if I were sitting in Frankfurt or Shanghai or Abu Dhabi, running a sovereign wealth fund or a large export firm's treasury, I'd be asking the same questions. Because you can't ignore the optics. On the one hand, you've got President Trump taking shots at Jay Powell, threatening to sack the man supposedly providing stability to the entire currency framework. On the other hand, you've got Powell himself, who for all his technocratic polish, is still trapped in the same game of debt monetization and desperate interest rate manipulation that his predecessors have been forced to play. And the real kicker? This is happening at a time when global trade volumes are actually rolling over. So if you're a large exporter, say BMW or Samsung or Aramco, you simply don't need as many dollars sloshing around on your balance sheet anymore. You see weaker order books, you see declining shipments, and you think, well, perhaps I'll convert some of these dollar holdings back into my home currency. Or more likely, given the euro's own structural issues, into something with no counterparty risk at all. Gold. That's the migration that's been quietly gathering steam for the last 5 or 6 years. And it's precisely why we've seen central banks becoming such aggressive net buyers of gold. The World Gold Council published data recently showing that central bank demand for gold was the highest in over 50 years. And of course, as Goldman Sachs rather belatedly admitted in a note last quarter, China is almost certainly buying at a clip 10 times higher than they publicly disclose. And let's not forget, China's been playing this long game since at least the early 1980s. As I pointed out before, after Mao died, one of the first quiet monetary reforms by the new leadership was to centralize all gold and silver policy under the People's Bank of China. They did this in 1983, granting the PBOC sole control over gold imports, exports, and accumulation. Then they patiently watched as a 2-decade bear market in gold gave them all the supply they could dream of, buying steadily, covertly, at cheap prices. By 2002, they had accumulated what I estimate to be around 20,000 tons of gold in state hands. Not necessarily declared as monetary reserves, mind you, but very real nonetheless. Then when they felt comfortable that they had sufficient strategic stockpiles, they opened up the Shanghai Gold Exchange and encouraged their citizens to buy. Since then, Chinese households have taken delivery of roughly 27,000 tons from the SGE vaults. That's on top of what the state itself still holds. So the question I often get is, well, Alasdair, if China has all this gold, why haven't they simply declared a gold-backed yuan? Why haven't they moved to dethrone the dollar outright? The answer is twofold. First, because it's not yet in their interest to force a sudden collapse of the dollar system, which still underpins global trade, including their own export machine. And second, because they're waiting for the US to do it to itself, which, by the way, we're well on the way to doing. With trillion-dollar deficits as far as the eye can see, a political establishment that can't even discuss fiscal restraint, and a central bank that has essentially promised to resume QE at the first sign of market turmoil, we are actively hollowing out the very foundations of our monetary credibility. And when Trump, for instance, talks openly about wanting a weaker dollar, when he boasts that the dollar should be lower to help our exports, that sends an unmistakable signal to every major foreign holder. Get out while you still can, or at the very least, hedge heavily with real assets. Because once the shift gains momentum, the exit doors will be very narrow indeed. This, by the way, is why we continue to see such resilience in gold and silver prices, despite what should be seasonally weak demand. As I mentioned earlier, in my old days as a stockbroker in London, summer was always dead. Clients would vanish off to Henley or Ascot, or down to Provence or Tuscany, and trying to get them on the phone was an exercise in futility. The same general malaise holds true for commodity markets. In quiet periods with no eager buyers, you typically expect prices to drift lower. But look at gold. It's hovering near all-time highs, not collapsing. Silver has barely pulled back from its run toward $38, and all this in an environment where retail interest is still practically non-existent. There are no hordes of ordinary investors rushing into coin shops. In fact, most are still off buying tech stocks and crypto, convinced that monetary policy can only ever be supportive of risky assets. It's precisely this complacency that sets up the next leg higher, because the underlying macro driver is not some speculative fever in metals. It's the visible, undeniable weakening of the world's primary reserve currency. Foreign holders of dollars are beginning to quietly, systematically diversify. And when that diversification accelerates from a trickle to a torrent, the move in gold and silver will be breathtaking. Now, a quick word on silver miners, because I think this is where some of the truly spectacular leverage will be found. Right now, we're seeing relative performance charts like SIL divided by GDX on the cusp of long-term breakouts. The silver miners have underperformed for years, but the momentum structures we track suggest that's about to change in dramatic fashion. Think about it. If silver pushes through its old nominal highs near $50, which in real inflation-adjusted terms is more like $200 or $300, the operational leverage for primary silver miners will be unlike anything in their modern history. Their input costs won't rise nearly as fast as their output value. And at the same time, the big gold miners, flush with profits, will start snapping up the juniors to expand their silver exposure. You've also got the fact that many of these juniors are trading for absolute peanuts. 50 cents, $1, $2 a share. These are lottery ticket prices. When the psychology flips, retail punters won't be chasing $100 stocks. They'll want thousands of shares of a little junior they can brag about. And as we saw back in the mid-2000s, that's when these names can go up 10, 20, even 50 times over a cycle. And here's something worth mentioning for your viewers who maybe haven't lived through a true secular commodities bull market. Unlike tech, where a massive rally is often met with insider selling and cash outs into dollars, in a gold and silver mania, people hold. They don't want dollars. The entire reason they bought in was to escape a system they no longer trust. So when prices go parabolic, there's no wave of eager sellers. In fact, the higher prices go, the more vindicated they feel, and the less likely they are to sell. This is also why I've argued for years that the real defining feature of this bull market won't be price, it will be availability. The mints, US, Canada, Austria, South Africa, Australia, the UK, are simply not equipped to handle a global panic. They are designed for a niche market of contrarians and long-term planners. If the average portfolio allocation to precious metals merely doubled from today's tiny 0.5% level to 1%, the industry would be wiped out overnight. If it ever reached 5% or 10%, there simply wouldn't be enough product to go around at any price that resembles today's. And don't be surprised when governments themselves intervene. You think the Perth Mint is going to keep shipping monster boxes to US dealers if Australians are queuing outside coin shops in Perth and Melbourne? You think the Royal Canadian Mint won't prioritize local demand? Of course they will. National interest comes first. That's when US investors trying to buy eagles or maples will find either enormous premiums or outright delays stretching months. So the takeaway here is simple. This is one of those rare moments where you can position ahead of the crowd with an extremely asymmetric risk-reward profile. Yes, it requires patience. Yes, you have to endure mocking from mainstream commentators who still believe Jay Powell can fix everything with another speech. But when the dam breaks, you'll be holding the most desirable insurance policy on earth. And you'll be holding it in physical form outside the financial system. Let me just close by reiterating something I often say. The endgame here isn't necessarily apocalyptic, but it will be transformational. We're watching the slow-motion fracture of a monetary order that's existed for over half a century. That doesn't mean the lights go out tomorrow, but it does mean that assets which represent timeless value, gold, silver, productive land, energy resources, are going to become ever more sought after. while claims on paper promises will be repriced lower, perhaps dramatically so. So keep your wits about you, ignore the noise, and remember, in every great historical wealth shift, it was those who moved early, while the crowd still laughed, who ended up preserving and multiplying their capital. That's the opportunity in front of us today.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.